We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gary Tanashian, founder and author of Notes from the Rabbit Hole. Thanks for joining me today, Gary.
Well, thank you for having me.
So why don't we start by having you tell us a little bit about your background? I read on your site that NFTRH, Notes from the Rabbit Hole, was launched right in the teeth of one of these liquidations on September 28th, 2008. And you go on to say that anybody can manage a calm market. Not everyone can manage a crash or be ready to deploy capital at a time of max fear. So how were you able to manage that time of fear in the markets?
Well, I would say the first step is to be ready for it, or as ready as you can be, given that none of us can predict the future. So it makes a whole lot of difference to your mindset if you're trapped on the wrong side of the market or an event like that, or if you're prepared. So for me, without predicting anything, we anticipated it. And at the same time, I started buying gold stocks, which were screaming higher fundamentally in that event way too soon. HUI 250. I held out my hands and the knives fell right through, and I bought 100 points lower, which mercifully ended up being the bottom. So it showed how something like that can really get out of control. And I thought I was prepared, but I wasn't fully. So we learned going forward.
Yeah, I think that's a very important idea that you and I discussed before we hit record here today, is the idea of, the fundamentals screaming one thing. Everybody can see that this gold stocks should be higher and we'll separate, let's say, the gold price from the gold stocks. And yet they're not acting that way. So, you said in our initial exchange that you aren't perma bullish or bearish, but kind of go back and forth. So what do you start to base those views on? What indicators do you look to decide when you're bullish and bearish gold?
Well, it's counterintuitive to what I think is the popular notion out there. It has not been bullish since mid-2020, or it had not. I believe it is bullish now and due to get more so. As inflation hit its peak, gold and gold stocks went bearish for good reason. They had led the way out of the 2020 mini crash. Gold went down, silver went down, miners went down. But when gold and commodities are measured together and crude oil, a mining cost input, is crashing in terms of gold, that's bottom line fuel for the sector, for the gold mining sector. Materials, human resources, you name it. And then psychologically, when stock markets are tanking in terms of gold, you have the full trifecta on positive fundamentals, because now you have the psychology and the sector's actual discrete fundamentals all kicking into gear. And unfortunately, those are also the times of some pretty intense selling of gold stocks if the majority of the investor base is in there for reasons of inflation, which I feel like an awful lot of a large percentage of them are. It's always a good time to buy gold stocks because inflation. And then that gets cleaned out during deflationary scares. And then it actually is a good time to buy gold stocks. Because using 2008, Q4 2008, right when NFTRH was launched, so it was the first thing I did was watch the process in real time. Gold topped out and corrected. Gold miners crashed to clean out the previous inflation phase of 2003 to 2008, clean out all the excess, the poor fundamentals, overvaluation, poorly run operations. I think that was kind of bred from that phase of inflationary excess where the gold miners went up, but gold was not going up in terms of oil, copper, other commodities, and not even stocks for much of that time as well. Mm-hmm. So, so we cleaned out the sector, and then that was the buy if you're ready for it. If you've got two hands to catch those knives with, and then keep on catching until you find the bottom, because the fundamentals were in line. And those fundamentals aren't the same fundamentals that most people are tempted to enter the sector for.
Where does that put us in contrast to today's market? You brought up the fact that oil being the major cost input for the gold miners, and they're really, by a lot of metrics, the miners have not gathered a lot of support yet, or a lot of momentum. So, contrast that period, that Q4 2008 in the miners versus where we are today, if you can.
Today is unfolding more slowly, I think. So after the sector peaked out in mid-2020, then came the inflation trades, or what I call the inflation trades in commodities. Stock markets kept going for quite a while. But the gold miners and the precious metals started leading everything downward. And so they bottomed in Q4 of 2022. And that's when the fundamentals also bottomed. As gold has been rising, it has been a leader. And the gold miners have been a leader of this, what I've been calling the Q4 2022 to Q1 2023, and now into Q2 rally. That they've been rallying with their best fundamentals because gold has been outperforming. Mm-hmm. And but we've only transitioned the macro into a Goldilocks phase now. You can see technology getting the bid. I like to say the machines are rotating predictably where the market is leading them. And so now tech, which got hammered in 2022, probably 2021 as well, it's getting a relief bid. They're spinning Goldilocks, which is not positive for gold. It's not positive for the inflation trades or any of that. Inflation's not too hot, not too cool yet. But my view is that we're transitioning from the 2020, 2021 inflation into the 2023 Goldilocks, which is going to morph. Where the Fed is getting off the gas now, or they're getting off the brakes, I should say. There should be no more rate hikes, and they only stop raising rates when the damage is done. So I think the momentum is going to roll it all over. But first, we have to finish up Goldilocks, centered in technology. Today, the precious metals got hit. No real technical damage at this point, so they could hold up and continue on upward, or we could continue into a more significant correction that could lead other markets as well. At some point, I believe Goldilocks is going to evaporate, and then we're going to be left with a liquidity crisis situation. For that, you watch gold versus silver, and that lurched upward today. You look for the US dollar to hold support. And really, the only bid the US dollar has is a liquidity crisis, which would come from participants fleeing from stocks and assets. A little bit of a panic, I guess you'd say. Mm-hmm. But that's all in line with good fundamentals for gold mining. But we've been on a pretty good rally since Q4. And, the first correction could be pretty harsh. And that could, you get through that, and then it's time to deploy, I think, as long as the fundamentals remain in line. And if the, they call the everything bubble, if that thing pops, in 2023, gold mining fundamentals are going to do very well. Even if gold doesn't go up, in that environment, gold versus mining cost inputs and versus markets that psychologically would aid the gold sector would also be very beneficial.
Mm-hmm. So maybe, Gary, we can kind of separate this into three pieces. Obviously we need a high gold price, so that being one piece. We need lower input costs, that being the second piece that isn't, let's say, necessarily there at this moment. And maybe that third piece is that momentum starting to come in and really drive those stocks higher. Is that a fair assessment of how the ingredients that we need to really make a big bull rally in the mining stocks themselves?
Well, I think the momentum will eventually be the product of the fundamentals. Nowhere else to turn. And why are these stocks doing okay? And why are they reporting improving earnings? Why are the performance? Why is the performance improving while everything else is crapping out? So it'll take time for the herd to take notice, but the momentum will be when non-gold bugs come flying in. Mm-hmm. I think that happened in the 2001 or 2 timeframe when we hit a big bear market in stocks and one sector was going up amid the deflationary pressures or just after the deflationary pressure. In microcosm, in Q4 2008, the gold miners bottomed hard, turned up hard, and then led everything. Mm-hmm. This time, I think it's more drawn out. Just as the improving fundamentals since Q4 2022 have been drawn out, it hasn't been just like a V crash and then resumption on the upside. It's more of a grind. So I think when the positively correlated cyclical macro rolls over for all to see, that's going to eventually be the momentum indicator right there. Because there's nothing like everything else failing for people to take notice of gold and then the equities that leverage gold. And so people have talked about gold miner leverage over the years, and they get pissed off that it doesn't work. And it does work. Gold miners have been leveraging poor fundamentals more often than not in the age of inflation since 2001, mm-hmm. with some glorious little interludes in between, but they can leverage a negative macro when gold is holding liquidity relative to all this other crap that's out there that has been inflated to the hilt. And to drone on a little bit more, the thing that makes today potentially special is that the Fed of today may not be the same Fed of the last 20 years. Their hands are tied, I think. And that's really the product of too many indicators for me to go into at the moment. But it's not the same Fed. They've I guess the term would be they've screwed the pooch here one time too many, And if that's the case, it's going to be a slow grind and the realization of a pivot to a counter-cyclical post-bubble backdrop. And I don't think the herds will thunder into gold stocks overnight. We don't want an overnight sensation. You want it to be like a grind, which it has been since Q4 mm-hmm. 2022. And I'd like to see that continue.
Well, I like that idea that you're presenting. It's almost like gold becomes undeniable, right?
Yeah, it's a constant.
Mm-hmm. We spoke before about the long-term stock market bubble as enabled by the Fed and why it actually might be different this time. So why is it different now than 3 years ago when the Fed really came to the service of the markets and right. dumped everything they had back in?
There are too many indicators for me to go through, mm-hmm. but I wish I had a picture of my favorite indicator, which is what I call the continuum. I'd hold it up right now, it's the 30-year bond yield. It's a monthly chart view reaching back decades. And that view has gone like this, just a gentle disinflationary macro signal over the years and decades. Mm-hmm. I use the monthly EMA exponential moving average 100 and the EMA 120, they've been the lines where the yield has bounced to every point along what I call the continuum and then failed. And every one of those inflationary failures has prompted the Fed to spring into action, into inflationary action, because we've had decades of declining bond yields, with the implication being that there's no inflation problem, so they're given license to inflate. So the inflation has been routinely produced by the disinflationary signaling on the macro, whether it's ginned up or not. They even 3 years ago, as you say, that continuum was intact. Those moving averages were intact. Every time the yield came up, it was repelled. Mm-hmm. And in 2020, most recently, it was repelled really far down, like crisis proportions. They inflated to beat the band there. So this is our EMA 120 right here, my arm. 2022, that thing broke.
Breakout, yeah.
It hammered the limiters, as I call them. Something different is happening on the macro. It's been a significant, profound change. Mm-hmm. And I'm not trying to say that one indicator, one bond market is the be-all, end-all, but it's very symbolic to me of what's going on. And the Fed is not going to inflate with Treasury bond yields broken to the upside like that. At least in my view, they're not going to be able to effectively do it because they've already been exposed to the light of day with the last inflation. They've always, or for the previous decades, they used deflation scares as the trigger to inflate. Mm-hmm. Well, this bond market signaling is broken. It's got out of control. So even if yields pull back now, there's a long way to go before they ever get back down to the levels from which they've used in the past to inflate the system. Mm-hmm. I just don't, I can't pretend to understand all the mechanics of it. I can't pretend to understand what their methods are or will be. I just know something is different. And it's something pretty profound from that vantage point, and other indicators as well, like the Fed's own bloated balance sheet, money supplies that got blown out of proportion and are rolling over now. So if they inflate again, I think there's going to be a lot of damage before they are given license once again to do so. There's going to be a lot of damage from this high level of long-term bond yields for one, stocks and assets for another. I mean, it's been a bubble like you read about. And, like you say, since 2013, I think you were saying, you haven't, every time you think it's going to get bearish, it magically doesn't. Well, with some of these inputs in play now from 2021 and 2022, I have to wonder, do they even have the tools anymore? And what might be the alternate tools globally that could be employed? Because I would never put it past these markets to find another foil for inflation or for asset prices to go up. It seems like there's always a new thing, and maybe it would be the tanking dollar. Except the dollar's holding support. And if we have a liquidity crisis, which is my favored scenario, they're going to run to the liquidity of the dollar and secondarily treasury bonds and gold. So it's not going to be the Fed if we are going to get a bailout. It's going to be some other macro situation, but I think it's out of the Fed's hands this time. And so for the previous decades, it's been the Fed that rides to the rescue. So either we're going to get a real unwinding bubble, or the rescue comes from something else. Long answer to a short question.
No, that's why we have the ability to not necessarily put a time cap on this, Gary, because I appreciate being able to get into the nuances of this. So when we think about this, let's say, looming deflationary idea that you present in your writing, is this something more so that we're going to look at as a crashing stock market, or let's say a credit crisis, something like that precipitates a dramatic deflationary event, or can it be a more drawn out deflationary event?
I think we're looking at a tipping point at some point. I don't know if it's going to be drawn out or a flash situation. I almost would like to see it be more drawn out. I feel like that would keep some of the manipulative forces sidelined longer. And while I'm not a fan of conspiracy theories, obviously the Fed manages financial markets through manipulation, as do any central bank. And just by definition, when you're buying and selling bonds and assets and bloating balance sheets and QTing balance sheets, that's manipulation in service to managing the financial markets. Mm-hmm. So I don't know, what happens in that regard. I just know it's heading in the right direction now. If you want to be a counter-cyclical player, if you want to be bullish on gold stocks, it's heading in the right direction. Unfortunately, if that gets impulsive to the downside, like you're describing, that right direction also brings downward price potential as well, like happened in a microcosm in 2008, the crash. Even as the gold oil ratio was screaming higher, gold versus stocks was like, that's why I bought so aggressively too early, because I'm like, oh, wow, look at that. I mean, this is going to be automatic fundamentals. And it was. Mm-hmm. But the moral hazard is who's selling and why, whether they're compelled to or whether they had incorrect reasons for even being in the sector. That has to be cleaned. Stocks, you look at a chart of the S&P 500 and it's just a massive bubble. And to this point, I've had to have restraint and to be bullish when the Fed was signaling bullish. Most recently, again, was Q1 2020. They were blowing the money supply, and they saved the day and reinflated the bubble and put a whole new leg on that thing. And this time, I just wonder if the same tools are there. I don't think they are. But the other question is, are there other tools that maybe globally could, see the currency markets come to the rescue or something like that?
Mm-hmm. So, Gary, if we do see a deflationary crash, any type of meaningful deflation, however you want to put it, surely the Fed will go back to its old playbook and at least try to fulfill its mandate of market stability. So do you think that, let's say, sparks that next inflationary leg higher?
So my view is deflationary scare first. And then I think that, yes, and going back to the continuum, which is my 30-year bond yield nickname. So we had the breakout above the limiters, above the boundary that had held it down. It pierced through there, went higher than I thought it was going to. I had it targeted at 4%. It went to around 4.4%. And now it's actually making a handle. I think they blew a gasket with that thing. Inflation blew a gasket. So any deflation that I'm seeing now may just be a correction back to test the breakout or the former boundary and test it now as support to a whole new era. So yes, there is the potential for the mother of inflation to come of this. So that's the other thing there, that the Fed may not be powerless, but if and when it tries again, I think the market has had enough. Finally, after 2+ decades of just the routine bubble making and inflating, I believe that the market has revulsion and has said that's enough now. I just have to believe that the people at the Fed are smart enough to see these indicators as well. I can't be the only lunatic out there looking at that stuff. But then again, if they're as academic as they appear and as robotic as they seem to be, maybe they don't know or care, and they'll try it again. But the macro has changed. Some important long-term indications have been put back on their ear, and just kind of turned around. So yes, inflation we could be looking at the von Mises crack up boom type thing. Who knows? I've tried to, over the years, not be a sayer of doom, but at the same time, it's because I have an inherent doom philosophy within me, because I don't think the system is right. I don't think it has been sustainable. I don't think it has been fair. I haven't favored it, but I've had to train myself and through my work to go with the reality of what we see and what's likely to happen within the constraints of the system we have. I just think the thing is broken now. So now it's off the hook.
I really don't think you're going to get much disagreement within this community about that. And I can really appreciate you, despite your outlook trying to be objective, despite that, let's say, predisposition, understanding the system for what it is. And, this leads us to obviously another big factor that affects the price of gold, and something that has been thrown about many times on this show, and that's the idea of de-dollarization. There's a lot of nuances to understand in this discussion. So from your point of view, where are we at in the moment of the de-dollarization path, and where do you see it going from here?
Well, it's funny. I just got hit over the head writing NFTRH last weekend, where I'm, full bore on my deflation scare thing, or the continuum of inflation morphing to disinflation, Goldilocks, to liquidation. So I saw that, but I also saw the dollar sitting there at support. The dollar is in a long-term bull market from the bottom in 2008. It's still in a bull market. I actually wrote a public article earlier this week and posted at the website, where I got hit over the head and said, "Easy, deflation boy, you better be considering all options." And that's where I had said a new inflation can come from a different place, like the anti-US dollar trade. The dollar has a lot of room to fall, even if it remains in a bull market. I turned myself around there. De-dollarization. I feel like it's a buzz phrase. So my initial view on it was to be leery of that, because people have been calling for the death of the dollar for a couple decades now. But there are valid inputs to that, or potentials for it. Look at the debt ceiling situation now in the U.S. The Fed is about to roll over on interest rates. It's not going to raise rates anymore unless the signaling coming out of the Fed futures markets is completely wrong.
Mhm.
But just today we got PPI rolling or easing, as has CPI. Everything's on track, and we're disinflationary now. But that implies a weak Fed. And what was it that supported the dollar through all the inflation trades in 2001 and 2002? It was the strong Fed, the hawking Fed, the Fed that got off its ass too late and started getting hawkish against the supposedly transitory inflation. So the dollar's right at a pivot point now. It's either going to hold, as was the implication today with the gold-silver ratio rising and the dollar maintaining support. But it's going to need a liquidity crisis or liquidity bid, which means it's going to need asset markets to come down, at least in the interim. It's either going to do that or it's going to lose support and the inflation is going to start sooner rather than later. I'm not going to be caught guessing at this point until I see marry some technical analysis with some indicators and some macro news. So we're at an interesting juncture right now.
Yeah, it's a big idea to try to think through, and I mean, we've had hours of discussion on this topic, but the idea that if the world starts to get rid of dollars, that is inflation and or loss of value,
right,
from a completely different source than we've had it, right?
Yeah. Well, the dollar has been the anti-market to everything else. I don't personally believe we're getting de-dollarized. I think that, I don't think one currency is better than the other in the developed world. Even the Swiss franc is suspect in these times, I think. But I tune out de-dollarization, even though I wrote an article with that in the title, because I have to take seriously that the dollar could get harpooned here, and that will bring out more of that talk. Mm-hmm. This geopolitics happening and the East versus the West, Russia, China, US. There are all sorts of rationale, but just as I've learned not to get too bearish until the indicators say so, I understand the politics. I understand certain tensions between rising, or let's just say alternate countries like Russia and China. I don't know if they're rising or not or whatever. China is obviously developing. And there's a lot of the world that would benefit, I think, from de-dollarizing. I just don't know the level of our hegemony on that still. I don't buy the end of America or anything like that. Mm-hmm. So to me, the financial markets are the financial markets, and they will decide. But I believe, sometimes the more things change, the more they stay the same. And maybe I'm old-fashioned, but I'm looking for a good old-fashioned liquidity crisis, and I don't think they're going to be buying rubles when that happens, or necessarily euros. Mm-hmm. Although, what do I know? I'm not a Forex trader. Mm-hmm. I just know that in my experience, if most of the world is still denominated in dollars, or most of the investing world and asset world, if that stuff rolls over, they're going to jump into dollars. Regardless of what they do after that, the dollar will have a short covering rally or a liquidity bid or whatever you'd want to call it.
Mm-hmm. Yeah, I think it's an interesting, counterpoint to consider that there's no other currency that can take the depth of liquidity like the US dollar, right? You can't put, billions and billions or trillions of dollars into any other currency.
I'm no expert on it. I just know what has always been, and I've also watched the death of the dollar stuff for decades now, and I'm still waiting. I don't know. I think all paper currencies are a different version of a Ponzi scheme or a debt scheme or whatever anyway.
Mm-hmm.
Hence gold and why I'm a gold bug.
Yeah.
Which, it's so simple, it's stupid, right? Not a Bitcoin bug or anything like that. Gold, I know it's a shiny rock. It's heavy. It has retained value over decades, centuries, millennia, whatever.
Mm-hmm.
So transitioning it to gold, not that I'm trying to lead the subject matter here, but gold has, in my view, is just a constant, an anchor. It's a thing that's out there constantly. And it gets marked up in its price when confidence is high. When confidence is low, it gets marked down when confidence is high. And that markdown is because the confidence is driving other assets, whether it's commodities or stocks, things that are cyclical and, pro the good stuff. And gold is really just, it is the sort of a fear asset in that you watch the herds jerk into it when everything else comes into question.
Mm-hmm.
So I'm no expert on the Forex markets and the technicalities within those markets. I just know that there's one thing that sits there and is assigned value based on the confidence of everything else or the lack of it.
Mm-hmm. So, Gary, one of those other, let's say, indicators that you watch, you've mentioned it a couple times, is, let's say, the gold to silver ratio. So how do you use that? And, reading that recent article of yours, there was a very big jump in it in the last day here. So how do you use that and what does it tell you?
Well, silver is part commodity. It's got more industrial metal utility than gold does. Gold is monetary. It's not really, it can be an inflation hedge, not a great one,
mm-hmm.
when inflation is working toward the betterment of a temporary betterment of economies, which it did after Q1 2020. Gold is monetary. It's liquidity. It's the Bob Hoy playbook. He was one of my influences. I'm sure you've heard of Bob Hoy. He calls it a metallic credit spread. So it acts like a quality bond versus more of a junk bond. And people are going to go for the quality in crisis. So it's not to disparage silver, but within the precious metals, it's like a very fine-tuned early indicator, where, or at least theoretically. But right now, gold is doing the same, doing much better versus copper, which makes more sense since silver is part precious metal as well. So it's like a more fine-tuned version of the gold-copper ratio, or gold versus other pure commodities that are the building materials of economies. So it's technically or theoretically, you can get a hint right then and there. If the gold-silver ratio is rising, even if silver is a precious metal, within the precious metal complex, risk is shifting toward off. Mm-hmm. So when you see that, that's the liquidity of gold versus the speculation aspects of silver gaining, which means liquidity is under threat in the broader markets. And if all is as it has been, the US dollar will go along for that ride as the global reserve currency. As much as people hate to admit that or say it out loud, it's still the global reserve currency until, to me anyway, it's proven otherwise. Mm-hmm. And when liquidity is under pressure, as indicated by gold rising versus silver, that's when you look to see if the US dollar is still on that playbook to gain the liquidity bids as people come out of markets. it's a little confusing, kind of a complicated situation, but it's what you have to look at to find the real clues.
Yeah, absolutely. And that's the thing. If you have studied these indicators over years and you understand, they have some type of correlation in your eyes, then
Right.
that can be a totally different way of looking at a chart versus, not necessarily understanding it from that vantage point. How about the gold to oil ratio? You mentioned that a lot earlier here. Is that one of the, let's say, barometers that you're going to be looking at to decide when to, let's say, fully deploy into miners again?
Well, I did that in 2008. Gold to oil crashed in terms of gold.
Mhm.
And so I'm like, oh boy, here we go. The fundamentals were screaming. So those were operational fundamentals. And then the more psychological, what I call macro fundamentals, with gold screaming higher versus everything, stocks, other commodities that aren't important to mining or whatever.
Mhm.
Those signals were in place when HUI was at 250 and when I did my first real buying. And then I, had to endure 100 points lower, and it just was off the charts bullish, and I couldn't be anything but fundamentally bullish. And that's what I do now too. But again, we've been grinding higher, which I like. So maybe there's not going to be the violent downside in gold stocks that there was back then, because there wasn't the violent knee jerk in the macro indicators. There isn't that now that there was back then. So maybe things are, taking their time and grinding logically into place. So I don't want to extrapolate everything from the past forward. So I'm just taking it week by week, month by month, and kind of gauging the process. But it's been in play since pretty much last October or November.
Mhm.
And it's been on plan. The corrections will come. The fundamentals are getting better. Today, the fundamentals got better and the stocks went down. That's fine. But today, the fundamentals took another jerk higher. Just look at gold versus copper,
Mhm.
which is more of a psychological thing, showing that the inflated macro took another step backward. And while gold went down and silver got hammered, the implied fundamentals were better. And so a lot of the gold bug community is rooting for silver to lead, because it's so often, and it's true, it so often goes in correlation with the gold miners. The gold miners track silver usually better than gold. But the fundamentals, with silver dropping today, or at least the implication, not that silver has anything to do with gold mining fundamentals, but the implication, the disinflationary, deflationary implication in today's little microcosm is positively in line with gold mining fundamentals.
Mhm.
It's just today I'm a guy talking about it. Tomorrow I'll be thinking about it as well. And it could take months till it all grinds out. And a grind is just fine for me. I'd rather not have too much excitement. But yeah, so a rising gold silver ratio will eventually prove it will help usher in the right backdrop if we're going to get a real bull market in gold stocks this time.
Mhm.
Which the real bull market has been foiled by central banks' inflation operations each time. Ultimately, back in the gold stocks rallied heavily from 2003 to 2008, but it was against their best fundamentals back then. So that's why I'm saying if we have an anti-US dollar de-dollarization play here in the coming months, the gold stocks will probably rally as well, but it won't be with their positive fundamentals. If the gold silver ratio rises, gold hammers copper, oil, all that stuff, but the US dollar also rises, as it usually does in those situations, then you're either going to get bullish gold miners with a bullish dollar, or you're going to get more buying opportunities and corrections. But either way, the fundamentals are still improving.
Mhm. So, Gary, is there a particular, let's say, subset of investors or section of the maybe institutional buyers that would come in once that inflationary input of oil and diesel prices resolves itself into a much better situation for the miners?
Yeah, I mean, I think we'll just watch the quarterly reports. In what casual attention I've paid to it this earnings season, I think that they've been doing fine. There are little hints that that the rising inflation costs are not the issue they were a couple quarters ago. So maybe it's, I think as gold bugs, we're trained to expect drama at every turn. And maybe we're just going to grind higher if it finally is a real bull market based on macro fundamentals. Maybe we will grind higher this time, and each quarterly release from the sector will kind of affirm that path. It's been doing it for a couple of quarters now.
You talk about the ASIC, or all-in sustaining cost, as a metric of mining, and we get that metric every quarter, as you say. Can that metric be somewhat misleading?
I have no idea.
Okay.
I'm not digging into balance sheets or how the miners are presenting their information or anything like that.
Mm-hmm.
So that's the thing about a macro top-down guy. He's looking at the top of the roof of the whole thing and taking that macro situation and then applying it to the stock sector.
Mm-hmm.
But I don't look into individual company filings or any of that. That would be my job, a stock analyst, if I did that.
Right.
So, I just know very stupidly that as these ratios change, so will the sustaining cost structures,
right,
however they present them.
Mm-hmm.
So I think it would be a company by company basis that would determine that. I do know it's important to trust management and trust track record and all that. Have investors' goals aligned with company management goals or actions. So very generally, the sector as a whole will benefit, regardless of what they're jiggering in the meantime on an individual company basis.
Mm-hmm. So, I guess inherent in that answer, Gary, I'd like to get a sense of how you look at what you want to buy when those signals come to you. Are you buying like an ETF of gold miners like GDX or HUI? How do you look at that?
Well, first off, I like the gold miners better than the royalties in this situation. Everybody knows the gold miners have been crappy businesses and the royalties have outperformed. And that's because they haven't borne the burden of some of these cost inputs and other geopolitical hazards that the miners take on. So from a value standpoint and a leverage standpoint, I'm looking at gold miners now. As far as quality gold miners, I have some friends, associates who I depend on for input from, as far as the boots on the ground from the individual operations. There are several miners I like, and then there are some I've kind of been trained not to go near. But I want the good, solid gold mining operations that are in safer jurisdictions. I don't know if there is such a thing anymore. If you want to listen to the ghost stories about nationalization and whatnot, there's risk in everything. But I don't think you can go wrong with a Barrick. Newmont has taken its slings and arrows. Kinross, the big names like that. Agnico Eagle is one that I actually hold. And then it gets more interesting as you go down the food chain and find the smaller and intermediate miners and the quality management. It gets challenging, and it's interesting to try to dig out the ones that are the most aligned with investors. Mm-hmm. But gold mining is what I want, risks and all, in this situation, because they're the ones using the oil. They're the ones using materials, human labor. And if all those things are easing, coming back to shifting to a more positive situation, the relative valuations to something like the royalties, that's where the leverage will be. Certainly not in a royalty company that's been very well valued all along, because it hasn't had some of the risks. Mm-hmm. And yeah, GDX, GDXJ, I think that's a good way to just play it as well. I choose individual miners, but if I didn't, I'd have no problem just buying the ETFs of gold mining companies, and they've obviously got some royalties in there as well, which is fine. I just wouldn't want to be focusing on those in this environment.
You like to separate out the metals, as you call it. Tell me a little bit about how you see that separation. Do you see the precious metals complex moving together relatively versus, let's say, the electric metals, the industrial metals? How do you want to separate that?
I separate it as gold. Mm-hmm. I mean, I'm very pure that way. There's gold. Silver is a speculation within the precious metals, and it can tear ass. Mm-hmm. But it's something that I also look at differently than gold. Gold is that anchor. And then you've got everything from battery metals to uranium to like all these other resources that will depend on getting through any liquidity crisis, interim liquidity crisis. And then that stuff will, I think the macro fundamentals and supply demand fundamentals of those things they're not going to stop unless the world stops. Mm-hmm. So, but for me, we're at a point where as I'm seeing deceleration, I think babies are going to get thrown out with bathwater, which includes the gold miners, possibly, as they have in the past during times when their fundamentals are getting better. But most stuff that's positively correlated to economies will at least get sold down temporarily, regardless of long-term supply demand for the future, which I think is very valid and will depend on the next recovery of investor mindset, as well as markets and economies. So again, for me, it's gold. I'm just very old-fashioned that way. And then there's all this other stuff, and I want to be ready for it. But gold is a completely different thing, like mm-hmm. completely different. The only thing near it for me is silver, and that's not even too close.
Gary, how do you go about trying to separate yourself from the herd, as you put it? How do you try to separate your thinking from the herd? Do you deliberately try to inform yourself from different sources, stick to your analytical process? How do you make sure that you aren't following any of the, let's say, the herd thought process, as you put it, is often wrong?
Well, first off, I ignore everything, which is why I'm not politically sophisticated. I am not mainstream financial news sophisticated. It's like, keep it simple, stupid, and look at what you look at and just keep it simple and watch the indicators. They'll tell everything. They're what's happening under the market surface. Somebody can say copper is gold, is the metals, all they want, and they can make persuasive arguments about China growth and this and that and the other thing, and I don't want to hear it. I don't care if China's growing. If I'm seeing the gold copper ratio ramping up like it is, I'm realizing that there's going to be a global economic blip at best or crisis at worst. Mm-hmm. So I don't care if China is saber rattling about Taiwan or Russia's doing whatever it's doing in Ukraine, and we're supplying, the weaponry on the other side, and the implications that somebody intellectualizes will happen. I can't listen to it. I have to tune it all out in favor of market signals. So that's my answer on that. I'm not the person you want to come to for market news or geopolitical news.
I like it. Staying focused on what you want to be.
Well, and what's actually happening. Mm-hmm. The signals are the signals. I think they're the most honest thing out there. They're the distillation of all the noise that's out there. They it's like coming through a still. It's coming right down, and the end product is what the market signals are, what they're saying. So you can cut out a lot of noise and emotion just by simplifying.
Mm-hmm. Well, Gary, I think that's a great place to kind of wrap up today's conversation. I enjoy reading your articles. They're, as I was telling you before, they're succinct. There's no fluff in them, but they're well written, and you have a lot of good data to back up your points. So for anybody that wants to check those out, that's available at nftrh.
You got it.
.com, right? Notes from the rabbit hole. It's easier to say it like that. And also nftrhgt on Twitter, right?
You got it.
Excellent. Gary, thanks so much for your time today. Appreciate you sharing your opinion with us.
Well, thanks for having me, Tom. I appreciate it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.